Did you know that Trump's tariffs could change the value of your properties? In fact, studies show that tariffs are imported on construction materials have increased building costs by as much as 25%. So, leading to higher home prices and reduced affordability. But how does this really impact your real estate investments? So, let's break it down. Tariffs have become one of the most debated topics in economic policy. And while they're often discussed in terms of trade wars and global competition, the real estate market feels the impact more than most people realize. So, whether you're a property owner, investor, or developer, these policies influence everything from the price of materials to the availability of foreign capital. Higher costs of raw materials mean that not only new developments, but also renovations, repairs could be cost surges. This squeezes homeowners and landlords alike. Forcing tariffs might seem like a far off issue for Wall Street, but they directly impact the market, and here is why. When the cost of construction materials like steel, lumber, aluminum increases, so does the cost of building new homes and apartments. These price hikes often lead to construction slowdowns as developers reassess feasibility. Developers pass these costs on to buyers and renters, making housing developments more expensive. Higher rental prices and mortgage costs push affordability out of reach for many first time homeowners, ultimately, reducing demand, showing the market's overall growth. Now, higher costs often lead to delayed projects, reducing supply and increasing competition for existing properties. With fewer developments entering the market, the housing shortages worsen, further driving up home prices. This creates in the market, making it harder for investors to predict returns. Market fluctuations driven by policy changes make long term investments much harder. So, how do exactly tariffs influence real estate? Let's break it down by three key areas. The first one, construction costs. The most obvious impact is building materials. When tariffs raise the price of steel and aluminum, developers face increased costs, making new construction more expensive. In some cases, this has led to projects being canceled altogether. Smaller developers are hit especially hard since they don't feel a financial cushion to absorb unexpected cost spikes. Additionally, higher costs trickle down to subcontractors and suppliers, make every aspect of construction more expensive. Two, housing supply. Fewer construction projects often mean lower supply of homes and apartments. This drives up property values and rental prices, making housing less affordable for buyers and tenants alike. Low income and middle class families are disproportionately affected as their ability to afford homes is eroded. Additionally, landlords see an opportunity to raise rents due to the limited apartments. So now that we understand where things are, this is where it gets interesting. While tariffs have raised costs, they've also created unexpected winners. So owners of existing properties with new construction slowing down, older properties become more valuable simply because there's less competition. As fewer homes and apartments are built, the demand for existing inventory increases, leading to potential windfall gains for current homeowners and long term investors. Investors and domestic suppliers, if you own shares in US based construction material companies, you might see an increased demand for their products as builders look for imported or not as the shift benefits companies that manufacture steel, lumber, and other key materials domestically as builders try to avoid costly tariffs on imports. Developers who plan ahead, those who lock in material prices or source from tariff exempt regions, can gain a competitive edge. Some developers have also adjusted their project timeline strategically, waiting for a more favorable time in the market. So, understanding tariffs is key decision maker to making smarter real estate investments. We've covered how they increase construction costs, limit housing supply, and affect foreign investment, but we've also seen how they can benefit certain investors and property owners. If you're an investor, developer, homeowner staying ahead of these trends, it will help you to strategize effectively. Monitoring policy changes and supply chain developments is essential for making informed decisions about property purchases, renovations, and investments. So, whether you're looking to buy, sell, or hold, understanding how tariffs impact the real estate market gives you a crucial advantage. So, what do you think? Are tariffs helping or hurting real estate? So, drop a comment below with your thoughts. And if you want to stay ahead of the real estate trends, check out my other videos on investment strategies. But don't forget to like and subscribe for more insights. Most investors struggle to navigate the complexities of multifamily real estate, especially with so many variables affecting decisions. Predicting job creation, vacancy rates, and rent growth can feel overwhelming because it requires a deep understanding of economic trends and local market dynamics. So that's why so many investments end up underperforming. But when you get a clear grasp of these market predictions, you can strategically invest in the top performing markets in 2025 and see increased returns. So continue ignoring these factors and you risk pouring money into properties that might not yield the expected profits, leaving you stuck in a cycle of stagnation. Now, let's dive into key insights from Marcus and Millichap's 2025 multifamily investment forecast. You'll learn why focusing on job creation is crucial for predicting multifamily demand. Job growth is directly tied to housing demand, which influences rental market performance, and understanding these trends gives investors an edge in selecting high return markets. So many people overlook job creation, thinking it's solely about numbers, but it's much more. For instance, the forecast predicts the US will add 1.8 million jobs in 2025. While that sounds significant, it is a slowdown from previous years. This sluggish pace is largely due to higher interest rates aimed at controlling inflation. Investors must pay attention to these trends because they affect rental demand and vacancy rates. By understanding these dynamics, you can avoid investing in markets where job growth doesn't support rental demand, thus preventing potential losses. For instance, Houston boasts strong expected job growth, which should help stabilize its vacancy rate and boost rents growth to over 3.1%. Keeping an eye on such forecasts equips you to make informed decisions. So, the actionable takeaways here is to always factor in job creation trends when evaluating market opportunities. This is the key to anticipating rental demand and occupancy rates. Next, let's explore how home ownership costs impact the multifamily market. With record high costs of home ownership, fewer tenants are leaving rentals for homes. This affordability gap keeps more people in the rental market and sustaining occupancy rates. For example, the report shows the strong lease renewal rates because many tenants can't financially and feasibly transition to home ownership. This is a golden opportunity for multifamily investors. By understanding the affordability gap, you can better predict which areas will maintain robust rental demand. And even in markets with high and new and apartment deliveries, like the Sunbelt metros, Richmond, for example, renewal rates tend to cushion rent growth. So focus your investment strategies on markets where homeowners remain out of the reach for most renters. This approach helps identify locations with high occupancy and significant potential for rent increases. On our final point, the supply dynamics with new developments. Understanding how new supply affects the market is vital. New apartment constructions can saturate the market, leading to concessions and slower rent growth. Miami, for instance, will see 8,100 new units in 2025, yet the vacancy rate is expected to dip thanks to strong migration and job creation. So the key is to identify markets where demand outstrips new supply. If you neglect this aspect, you might find yourself invested in areas with failing rents due to oversupply. By targeting markets with balanced demand and rental supply, you ensure steady growth and avoid pitfalls associated with overdevelopment. So overall, the Marcus and Millichap forecast arms investors with crucial insights to make smarter decisions in the multifamily market. Subscribe to stay updated with more insightful videos on navigating real estate investments.